various members of the board who have real questions or concerns about the asset allocation strategy, number one. And number two, we're at a very low funded level. And I'd like to make certain we've given full thought and consideration of steps that at least expected over the next 5 years, if not the next 10 or 20. At least over the next 5 years, we are well positioned because we got to bring the dam, excuse the word dam, you can cut that out twice. We have to make certain we drive the funded ratio up. Okay. First item of normal usual business is the approval of the minutes of the last meeting. The approval of the the minutes of the regular board meeting of September 24th. Item 2A, may I have a motion for approval?
Second.
Paul and Jody, all in favor?
Aye.
Aye.
Okay, approval of the minutes, however brief they are, of the closed session of September the 24th.
Moved.
Second.
The dynamic duo once again. In reverse order this one. Next item of business is number 3, the retirement request or retirement and death benefit request. Item 3A, civilian requests. Are there any questions? Recognizing we're going to go into executive session at the end of our normal discussion to talk about a particular civilian request that has been made that is questionable. But of the individuals who are listed here, are there any questions about their eligibility or none? I have a motion for approval. So
Second.
Paul and Jody, all in favor?
Aye.
Okay. Police requests. May I have a motion for approval there?
There's none.
Yes.
There's none.
Okay, I guess we don't need a formal approval, we simply accept
Right.
there is none.
Zero retirement.
Right, okay.
Going to death benefits. We have no requests, excuse me, that's not correct.
There are 8
That's
requests.
retirement. I'm on the wrong page here. It's, there we go. Civilian requests, we have 8.
With 6 deaths.
I'm sorry,
8 requests.
8 requests, but not 8
with 6
deaths, but yeah, right. Okay, may I have a motion for,
So moved.
Second.
and police, we have only 2 requests, I think. May I have a motion for approval?
And second.
Okay, done. Now, next item of business. Is the annual actuarial report, and procedurally, we have to vote to accept the report. We took it at the last meeting that it was, what we discussed was approved, but we did not actually approve it technically. But nevertheless, the county has moved on with the plan as the actuarial numbers as outlined. So I have a formal motion to approve the actuarial report.
Second.
All those in favor?
Aye.
Aye.
Okay, co-consideration. I promised one of our retirees who had lobbied for this a long time, that we would put into the new ordinance the timetable that we would review the possibility of recommending COLA at a certain time during the course of the year. In fact, in the ordinance, it's going to be after receipt of the actuarial report. I would like to go on record that we considered that this year, implicitly we did, and we decided not to recommend a COLA, and there is no COLA in the county director's budget, but we did not actually procedurally make that recommendation. So may I have a motion?
So moved.
Second.
All those in favor?
Aye.
Aye.
Okay, good.
every, okay.
That is simply as a formality of
Did you
something we
vote for
already.
I'm not even sure what we were voting on. I'm not sure what the motion was.
All right. The motion was that we not recommend a COLA this for the upcoming.
Yeah, I'll abstain.
Okay, and we're okay, we need 3 of 4, I re-looked at it. Okay,
3 of the 4. Okay, very good. Now, the performance report, the ACG analysis presentation. We will not talk about domestic versus international equity allocation. We will talk about that as part of the overall asset allocation strategy, which we were to discuss today, but we're now going to discuss in November. Okay, Benny, why don't you take it from there?
Perfect, I will. So yeah, so a couple of things today. So do have an update on our performance report through the end of September. So we'll go through that. Overall, really strong market performance. From a manager perspective, after that, I do want to hit on some follow-up discussion. If you remember, one of our fixed income managers, Western Asset Management, we have some qualitative concerns about, so do recommend looking at potential replacements. I have some few ideas there. Really kind of be the bulk of what we talked to. So for the first page I'll go through, so it says monthly ASAP report
Yep.
here on the bottom.
Yep.
And as if we flip over here to page 3, just again, kind of reset for the markets. This is all as at the end of September. So really the big news in the month of September was that the Fed actually cut interest rates. This was the first cut the Fed has made in over 4 years, since 2020. The question wasn't if the Fed was going to cut, it was by how much. People were unsure if it would be 25 or 50 basis points. Ultimately, the Fed decided to cut 50 basis points. They felt that inflation numbers in particular had come well within bands, that they felt comfortable with this cut. This was taken certainly as positive news, stimulative from an economic market standpoint. And then I'll also point out as the third bullet here, but we saw this positive kind of economic news with the Fed cut in September. But China also unveiled a very comprehensive stimulus package as it relates to rates in their economy. So you can see if we look here on the left-hand side of the page, we have all our various indices for returns. The dark blue is for the month of September, the light blue year to date. We're now 9 months through the calendar year. So you can see China's stimulus in particular really led emerging markets for the month of September, rebound almost 7% in terms of returns. But looking down all those other blue bars, certainly very positive. You see all the equity bars positive, the S&P 500 up over 2%, international EFA and small cap at the bottom up about 1%. And then of course, bond prices get a little bit of a boost, right? As interest rates goes down, that puts more value on the bonds we currently hold in our portfolio. So positive across the board. And the one thing that's not on here, that's not reflected yet in our performance that I'll show you, but the Odyssey Index. We're going to talk about real estate here just in a little bit. But the Odyssey Index, again, what that is, it brings together about 30 different core real estate funds, institutional quality size across the country, and it's the median return of that group. That was positive for the first time for the last 2 years. Very minimally positive, up about 30 basis points, but actually still positive for the first quarter in about 2 years, a little over 2 years actually. So again, we're starting to see some of this.
Is that the best benchmark to use, the Odyssey for real estate?
Yes, it is, because there's no way within real estate really to passively invest, particularly in the types of investment properties that we invest in. And so what the Odyssey is simply just a combination of all the largest core real estate funds to look at. So we'll see how our managers do for the quarter, but it was for the first time positive. And then we'll point out again, just, year to date continues to be a very strong year in terms of returns. Those are those light blue lines. The S&P 500 U.S. large cap again has really led it. A lot of this really in the first half of this year, driven by the Magnificent Seven technology stocks. We've talked a lot about that, but you can see, and this affects our performance, even year to date, looking at the Russell 2000, U.S. small cap is the bottom row. Up 11%, very strong through 9 months, but that's still 10% behind, actually half what the S&P 500 is. You can see international. This is something to really talk more about next month as we get into that. All the headlines on the U.S., but certainly see some strong rebound in international equities, emerging markets, and developed up both in the teens so far this year. And then lastly, part of this has led certainly to the strong rebound in returns, also in the Fed having some confidence to with what it's done with interest rate levels. But you can see from a GDP perspective, so this graph on the further right, again, GDP is the level of economic activity that we monitor. And there's various different groups that put together their models and expectations for what GDP will ultimately come in at. But you can see regardless of which one it is, all four of these indices actually have higher and some significantly higher expectations in September than they did even a month earlier. So certainly, again, a lot of positive momentum going on in the economy. And again, continuing to be led by the consumer, continuing to spend and certainly support businesses. If we want to flip to our performance numbers, then we can go to page 5. As of the end of September, and again, we don't have real estate in here. We'll bring this back next month for the actual returns, but with everything else. So you can see our portfolio just south there of $900 million as
You expect real estate return to be
So-
very modestly. up.
modestly positive is our expectation. Modestly positive is
So
our
that's pretty much
expectation.
detrimental to what you're reporting. Okay, go ahead, please.
But so you can see we're just under that 900 million mark at $896 million in the portfolio. So certainly if you look kind of across the top, particularly for the quarter and year to date, really strong numbers. We're up over just under 5%. And again, all of our returns we're looking at here, net of all manager fees, 5% in the third quarter alone. Year to date, we're just at 10%. So the last 9 months, we're up 9.98. And for the trailing year, so this brings into account fourth quarter of last year, which you remember was pretty positive. Really strong numbers over the last 12 months, almost 19%, 18.8. You can see our benchmark strategic policy index is up a little about 1.25% more than us. And I'll hit on that in a second why. 20%, but ultimately certainly 18.8% over the last 12 months. Certainly very strong performance. Still continuing reminding everyone, and it's a good visual just how markets ebb and flow. The last year we're up almost 19%. The last 3 years we're up under 3% on a per year basis. But the last 5 years we're up 8.5% on a per year basis, net of all fees. And again, you can see that's about almost a 0.5 percentage point above our strategic policy index on a per year basis.
When do you think you'll have the real estate results?
We will have them. They should be coming in now. I haven't seen them come across, but we'll certainly have them. So at our November meeting, if you remember, we'll have our big quarterly book that will include final performance, including real estate.
What I'm going to ask you to do is update this as soon as you get the real estate numbers and send it out to the board.
Yeah.
Independent of November meeting, so we'll have that in mind as we sit down.
Yeah.
As you said, it's probably going to be relatively flat to modestly up, both for the index as well as for ourselves. So the numbers here won't materially change in theory, but nevertheless, I'd like to see that.
Yeah.
As soon as it's available.
No, I mean, it's a big part of our portfolio, over $100 million. And
Yeah.
so we'll definitely, but yeah, we don't expect huge performance.
And let's understand,
given this quarter.
over the last 3 years, well, 3 years is horrible, but everything was horrible because that includes 2022.
Yes.
But over the last year, we're up 19%, although our real estate portfolio was down 6%. I mean, there was a great opportunity loss here. I mean, we're actually doing okay overall, but that is what really has held us back, both for 12-month period, 3-year period, and for that matter, even a 5-year period.
Yeah. Well, and I think it's very important too, and we'll talk more about this next month. We talk about capital market expectations, and certainly valuations are high. So everyone's a little bit cautious. You would have said that 12 months ago. Everybody would have said that 12 months ago. Everyone thought things were expensive. And of course, you can see if someone would have made drastic changes to their portfolio over the last 12 months, you'd missed out on about a 19% return. And just looking at that 1 year, and I do want to point out, so you can see we're up just under 19%. Our benchmark is up 20%. First off, part of our portfolio, as we think about structuring this, particularly from our manager's perspective, again, with manager selection, with everything, there's a little bit of a double-edged sword. You can't have all the upside, but then get all the downside protection. And so we do like to structure our portfolio with a little bit of that downside bias. So in years where the portfolio is screaming up, we might trail a little bit. But just to point out where, just over the past year and a half, this 1.2 underperformance is coming from. Really the bulk of it, if you look down at that first row, US equities, so US equities overall. The Russell 3000 is the broad US equity index and includes large and small on a market cap weighted basis. And you can see we trail that by our US equity portfolio trails that by about 4% over the last 12 months. That's driven by two things. First, and probably the most significant aspect of that, is our weight of small cap relative to large cap in our portfolio versus the index. What I mean by that, the Russell 3000 is primarily large cap. It is still driven by large cap securities. It is market cap driven. It's about 85% large cap, 15% small cap. Our portfolio is more of a 70% large cap, 30% small cap. So that's a pretty big difference if you think back to the page I showed you before, where there's a 10% difference between large and small this year. So that's really driving the bulk of this.
And then, and even in the large cap arena, I mean, it's accelerated a great deal because of NVIDIA, because of Apple staying constant, but because a lot of technology stocks, not even, matter of fact, even Berkshire Hathaway's had a very good year. So that normal, when you think of the Russell 3000, as you said, I've always thought of it as 70% large cap, 20% mid cap, 10% small cap. But what is 70% is just really accelerated,
Right.
because of the technological revolution that's going on, particularly with AI.
And so we certainly were exposed to that. We're benefiting from that performance, but again, a lot of times it's brought up in here about the valuations. It's expensive, particularly the large cap area of the market. And so just again, so the group knows we're actually underweight the large cap group of the market relative to what's in our benchmark. So that's causing it. And then within US small cap, one of our managers, Granite, has had some underperformance. Actually, both our managers have struggled this year by, again, in a very large up market. You can see combined, they're up almost 18% when the benchmark's up 26. A lot of this came this summer. So what happened is rates in July in particular became evident were going to start being cut. This really benefited some of the more speculative small cap companies in the US, particularly banks, which really lifted up in the index, but our managers don't tend to own a lot of them. And so you can see about an 8% year, 1 year underperformance combined of our two small cap managers, really with this more of a low quality rally happening in the summer because of the rise, because of the expectation and the actual cut in interest rates. We don't have any concerns with these two, and you can actually see longer term, particularly over the 5 years, really strong performance from these two managers. But overall, looking down the page, and Milt kind of pointed out, you look at non-US equity, that next row there, you know, really overall strong performance. We're on top of our benchmark in a big up year, up 25%. I do want to point out, look to the second to last row of this, fixed income. Fixed income added 12% to our portfolio over the last year. Again, this certainly hurt our portfolio in terms of returns in 2022 when rates shot up quite a bit, but our managers certainly did a great job redeploying capital, investing in some of these higher yielding securities. So up 12%. And then certainly, as Milt pointed out, real estate has been the drag. So this great return that we happened over this past year, we've had in spite of real estate being a negative drag on our portfolio.
We're going to go back to Granite, are we not?
Yes.
And if you look at Granite's performance, whether it's 12-month period or 5-year period, I still have concerns, and that's why we have them here, and I'm waiting for a specific recommendation from you guys as to whether or not we ought to retain Granite or replace it. I have no concern about earnings.
So yeah, we're happy to go to Granite. Again, just final point on real estate.
Yeah.
So again, this great performance this year with real estate, even kind of pulling us down. But that's why we diversification the portfolio. We all know a couple of years ago in 22, in particular, real estate really helped us out. As we're starting to see, again, you never really call a bottom, but just leveling out and resetting in the real estate market overall, we are optimistic looking forward. And in fact, as we talk about capital market expectations next month, you know, we would expect real estate looking forward actually to be higher capital market expectations going forward. So switching over to Granite. and you can look at their performance over here on page 6. So overall, if you look at their performance, again, this year, in particular, they're up 15% almost, but struggle with the overall US small cap market. This just really rebounded. Again, in particular, a lot of this underperformance this year, mostly coming from the summer. So in July, just in July itself, the Russell 2000 was up 10% and Granite was up 5%. And a lot of this had to do with this big rebound excitement about interest rates being cut. And again, if you think about interest rates being cut, what does that do? Makes it cheaper to borrow, particularly for companies who need access to capital. Granite, while they're more of a core growth manager, certainly these more speculative companies tend to do better than Granite did. This has certainly hurt their relative performance over the past 12 months. If you're down 12% relative, that certainly impacts your 3, 5 year, et cetera. Ultimately, my recommendation is to retain Granite. We still continue to like Granite. We continue to think their disciplined process about how they evaluate companies, their qualitative focus, similar to, if you remember, we had William Blair in here just a couple months ago talking about there's certainly going to be big ebbs and flows, particularly relative to a core benchmark, the Russell 2000, which they are here, which, again, they could be core or growth.
If we go back to December 31st, 2023, and look at Granite's trailing performance, I think we would still come to conclusion they're lagging dramatically.
So not over time. So if you look at this, so they've been in our portfolio
Since 2014, I understand. I was here when we put them in.
Yeah. So they've been ahead. So they are ahead. I mean, it's 11 basis points now. That's come down quite a bit over the 10 years. They're up 12, or excuse me, they're down 12. This past 12 months has certainly put a big hurt on that. I think, we'll bring it back for you, Milt, next month, but for the 5 years, and I'm trying to think, I think they'd probably be ahead. Maybe for the 3 years, they would be down, but we can bring that back. But this most recent period has certainly really driven some of this, particularly 3 and 5 year trailing numbers.
I understand, but they're paid to be in the right place at the right time.
Well, we certainly agree with that, but
I don't expect them to outperform every year, but this is pretty dramatic difference.
again, a lot of this being time period specific.
Yeah. 1 year period's 12 percentage points. I've always found there to be a very thin line between being patient and indulgent. And we may have crossed that line. And that's why I'd like to see what other managers you would recommend to replace Grant.
Sure, obviously, we always have the bench in all the asset classes, so we can bring that back and compare how they have done, particularly year over year. Do you think what you'll see with Grant, well, you'll see with all these managers, there is a decent amount of tracking here, in other words, difference in between year over year versus the benchmark year over year.
And the size of the portfolio will make a difference because that's going to lead to more volatility, positive as well as negative.
Right.
All that's true. They're paid to be in the right place at the right time. Have they been relative to, well, they haven't been relative to the index. Have they been relative to the other managers that you would recommend that we consider?
In some ways, it just depends a little bit on there. So I think will be helpful. So we'll bring back some other managers next month. What you'll also see when we bring back our big quarterly book, what we have for Granite and all of our managers, is not just do we show the 1, 3, 5, and 10, we show the calendar years, right? So 22, 23, et cetera, 21. And what you'll see with Granite is certainly, and it's relative, it's their returns relative to the benchmark, relative to the peer set, small cap managers.
Yeah.
And what you'll see the several years within there, Granite being certainly very much at the top, certainly in the right place at the right time, and then other years certainly towards the bottom. And so how that ultimately kind of brings together. And then, so we will have that in that quarterly book, and then we can show too how some of our bench compares.
All right. Go on. We're going to go to the international side now. Comments?
Yeah, so on the international side, so overall, our international portfolio, as I just said, really right on top of the benchmark for the year. Breaking the managers down, what you'll see on our large cap developed side, Silchester and WCM, again, both compared to core benchmarks, But we know WCM certainly on the growth side, Silchester on the value side. And what you see is similar to theme in the US, although not as extreme. Growth has performed better overall the last year. So if you look at the 1-year numbers, Silchester up 18%, WCM up 29%. So you can see WCM outperform its benchmark, Silchester trailing. But we did see a little bit of that switch in this past quarter last year, and that pendulum swing a little bit on the value growth side within international. And so ultimately you can see kind of quite a big difference just for the quarter. Again, Silchester up almost 10%, whereas WCM up 5%. And again, you can see difference over and under versus their benchmark there. So again, we think great diversification between those two, continue to complement each other quite well. William Blair. So again, on the growth side, we compare them to growth, to both the growth benchmark and their core benchmark. They were in over the a couple months ago now, and ultimately you look over the last trailing year in particular, returns certainly very strong, up over 21% in the international small cap space. We continue to like the international small cap space, but certainly longer term they have struggled quite a bit from some of this performance. And if you remember in particular, they showed this came from a couple just particular calendar years where again they were heroes, if you will, well ahead of the benchmark, and then certainly that flipped real quick right away.
It was my observation, and correct me if I'm wrong, it was my observation that their recent underperformance versus benchmark was due to 1 year. When they gave their presentation, I think it really came down to one particular year where really lagged the benchmark dramatically. And everybody's going to have a really bad year, no matter how good they are. So I don't criticize them for having one bad year. But am I correct or incorrect in my conclusion that it's really due, this historical performance is really due to one bad year?
Well, in the short term, yes. I mean, particularly that is the case. It was one really bad year, and they had,
I'm talking about the last 5-year period.
the last 5 years was, yes, one bad year. But there was also-
They presented, as I recall, and it came down to one bad year.
It
They
did.
presented the calendar year returns.
One bad year, but it's also on the flip side, they had, I think, leading up to that, one really good year right before it, which helped salvage that. I mean, very similar to the Granite discussion, are going to have big peaks and valleys.
And in fact, they had 2 really good years prior to that.
Yeah.
Not, as I recall, not consecutive. The 2 really good years of the prior 3 or 4, which were exceptionally good. But they had one bad year, which drove down their performance on a 3-year basis. And so I walked into the meeting thinking that we had a problem with William Blair, whereas historically I had a lot of confidence in William Blair. I walked out of the meeting thinking, hell, they had a bad year. The whole thing comes down to one bad year, and therefore they're worth staying with. But tell me if I'm wrong. And Tony, do you have any opinion on William Blair based on what you saw the last meeting? Am I?
Not a strong opinion, Milt. I think I do probably appreciate the longer term perspective. But I don't know that I have a strong reaction or takeaway other than just to kind of think of it through the rolling cycles, and I'd be supportive of a longer term view.
Oh, okay, so you're saying that you would, if we had to make a decision to retain or fire, you would retain at this point?
I'd be in the camp of retain. Yep.
So am I, and I wasn't in the camp as I entered the meeting, but it came down to that 1 year. Again, we're going through this, so the whole board has an opportunity to opine and to understand what the logic is of keeping a management, which apparently in the short term, at least, has had relatively poor relative performance. That's why we're going through this. But at the same time, just when I was in consulting, the difference, that very thin line between being patient and indulgent has to be observed. And we can't allow ourselves to say, well, they'll get out of it. We've got to be really hard-nosed about this. It's big money, and the county is way behind on its funded ratio, and I'd like to see that improve dramatically over the next several years.
Yeah, see, I agree with all you're saying about the long-term approach, and I mean, I will tell you that, I mean, granted, we were talking about earlier, and William Blair will be another one. They're gonna have big differences to the good side and the bad side versus the benchmark. It's gonna continue. It will continue, and I think the bigger question is, are we comfortable taking that approach? If we think both managers do a great job and have, to what Tony was saying, that longer term proven track record of over time, their process, how they evaluate managers, quality of the individual companies, their financial well-being is a huge input in both of their processes, has proved to work well over time. But there can be big divergences. In particular, I think of William Blair, I think it was 22 that really hurt him, but then there were also a few years, I think in particular between 15, 16, and 17, that they did very, very well. Granted would have a similar kind of aspect to it. And so for us, certainly, I think both of them have demonstrated that long period of time, but we have to be somewhat faithful and stay with them and evaluate, is anything changing in their process? That's really kind of the key. Are the people changing? Is the process changing? And if it's not, it might just be, kind of some of the market dynamics that are in play. And I think it's also very important that we, understand what the sizing of each of these managers is within our portfolio, because that is also very deliberate and very important. William Blair is 2.5% of our overall portfolio. And that's kind of by design. We know this is an area that could be quite volatile. Even within US small cap, we want to keep that kind of right around that 5% per manager. Because we know certainly it is a volatile area in the portfolio with, it has shown pretty higher tracking error, particularly relative to a large cap. And so ultimately would agree that we don't think there's anything different with William Blair than when we hired them. They're going to have they had a very bad year from relative performance standpoint a couple of years ago. They've had some very good years, and we think that'll kind of continue.
Is there anything else you want to say about any of the other managers?
No, I mean, overall, again, no. Within emerging markets, again, Acadian continuing to perform quite well. That's adding strong performance for us. And again, we don't have real estate numbers up to date. But you can see all of our managers. Certainly, it's been a slog the last really 2 years in the real estate market. Our managers have taken their lumps from returns, but you can see it's held up pretty well.
When was the last year that the real estate sector had a good year?
22. So 22 is very strong performance in real estate. If you remember, the index itself was up 10, I think it was 10, 12% when equities, fixed income were down. And then we've seen that pendulum completely switch over the last 2 years.
We have a choice. We're locked in here anyway. And I'm still of the mind, there are two things that I would like for us to reassess when it's practical to reassess them. Our domestic equity versus international equity allocation, but that will come out in our asset allocation discussions. But also because I favor reducing international by 5 percentage points and increasing domestic by 5 percentage points. And I'd like to hear a compelling reason why we should not do that. And I'm not looking at a 20-year view. 20-year view would argue something different. But we've got to eat in the meantime, and can't eat on 20-year numbers yet, shorter term. But the other is real estate, which we talked about before, and whether or not the current overall allocation of real estate is appropriate. And I say that as being the only person in this room who was part of the decision in making real estate such a high percentage of our portfolio. It was years before anybody else was on the board. So I have a perspective of why we did it, but I also now have a new perspective as is it appropriate?
Maybe the last thing on this page is going to transition to, we're talking next about fixed income. And so just if you're on page 7 of the performance report,
Yes.
again, we have 2 fixed income managers. IRNM, kind of we divide them in half, basically. They're kind of right on top of each
Fixed
other.
income review.
Yes, and I was just going to show the returns really quick before I transition to Fixed Income.
Okay.
So IRNM and then Western Asset Management. And just as a reminder, how we, both managers focus a little bit on separate deals, in that IRNM is really our very safe core manager. So when you say that, think they invest in very high quality bonds, particularly a lot of treasury bonds, highly rated corporate bonds, et cetera. Western Asset Management has some of those, but then they also go out on the risk spectrum a little bit, get some of the higher yielding, lend with more speculative companies, they get paid a higher yield over time, but it comes with a little more risk. And you see that in their returns. I'm just going to show you here if you're looking at page 7 of the performance report. So over the past year, when it's been a great environment for bonds, right? Bonds have rallied. You can see both managers have done very well, but you can see Western outperforms by about 1% over that time period. Conversely, over the 3 years, when we know interest rates, when they rose quite a bit, that put some pressure on bond prices, put some fears of the recession in the economy. You can see overall IRNM protects better from from a downside perspective than a Western, and that's kind of how the two work together. We call IRNM more of a core manager, Western a core plus, meaning they include some of that plus risk on spectrum. And I bring that up because we are recommending replacing Western.
Here's one other observation I would make. Both fixed income managers have been in a portfolio longer than 10 years. So if you look at the 10-year numbers, which will include various cycles, I think mostly interest rates went down, but nevertheless, because the Fed was on a 10-year, ever since 2009, the interest rates basically have been down. But over a 10-year period, they're almost neck and neck. It's only 2.05 to 2.08 over a 10-year period of time, which is meager returns, but through several cycles. It's just an observation. I'm not arguing for less than our current 22% allocation to
fixed income, yeah.
Right now, I'm not arguing for less, but we haven't gotten much out of it over a 10-year period of time, except less volatility.
Less volatility. And so certainly, yeah, the 10 years, again, this just kind of shows long periods of time what they can do. But also, if you look at this 5-year number, in terms of the returns for both of them, you can see IRNM is positive, up about 66 basis points per year. Again, net of fees. WAMCO is down 1% per year.
Down 0.5%.
0.5%, yes, down 0.5% per year over the last 5 years. Really, again, driven by what happened mostly in 2022 and how much, some of this economic turmoil and also, so 2022 and then economic turmoil. And so this 5 years certainly done well by IRNM. The 5 years before that, obviously Western would have had to outperform IRNM by about 1% a year to bring that up. And that's because if you think about those years, those tend to be pretty strong economic years, not a tremendous amount of turmoil. And so certainly the risk on posture had helped them. But
are we therefore saying that in terms of their return, we are satisfied with their performance, particularly since the Bloomberg aggregate only was up 1.84% over that 10-year period, and they both were above that. So there wasn't much of an opportunity to begin with.
Right, so we would like to replace Western not for performance reasons. I think we would acknowledge we're not super excited about their performance. We think it's fine. It's in line with expectations. And again, they've been more of a risk on manager that they felt the pain and they're still feeling the pain a little bit from 22. We kind of saw they're digging it out. Very strong performance this last calendar year. They'd probably expect to do some of that, their strategy and style going forward. But it's more so the qualitative issues that are going on for firm and the other pension plans, other systems around the country who are leaving their portfolio. We think is only going to put some more pressure on the team. But ultimately, from our standpoint, we don't think it's necessary or worthwhile sticking around with Western. And just a recap of what happened, ultimately, it's on page 4.
Mm-hmm.
This
is on the fixed income.
On the fixed income review, so it's titled Fixed Income Review.
Yeah.
And we hit on a lot of these points last month, but just in highlight, at the very end of July, again, Western is owned by Templeton, so it had to wait till their earnings announcement was released. But it was announced by the SEC, Department of Justice. They were investigating some trade allocations with some different Treasury securities in these trading strategies that have been used within the WAMCO portfolio over the last several years. About a month later, They announced that co-CIO Ken Leach, he kind of works in these core plus strategies, was taking leave of absence as he was involved in some of these trading strategies and while it was being reviewed. Ken's departure, I guess I should say leave of absence, is on the heels of a few other higher level departures, really over the last 6 months, over last year, including John Bellows, kind of PM, head of broad markets, and a few other individuals. And so ultimately, some of this turnover at the top, certainly these investigations by the DOJ, the Wells notice of potential, how they were trading, allocated, not being fairly distributed, gives us some concerns. I mean, listen, it's of note, WAMCO, they've said they reviewed their trade allocations. They think they're in line with everything. The due diligence and due process is being taken place. But ultimately, a lot of red flags here with departures, with potential issues of trading inequity. WAMCO itself, both the core plus strategy and the firm are very large, so we're not necessarily worried about them going out of business, but there is a lot of pressure, and we have seen a lot of assets move. It was kind of already leaning that way with some of their performance struggles over the last year or two, and then this announcement really accelerated that. So if you can see that the strategy that we're in, the core plus strategy, as of June 30th, at $67 billion in its strategy, it was about double that 3 years ago at $120 billion. But now it's down to 67 billion-ish, and then expectations.
Did that attrition really occur in 2024, or was it?
I think a lot of it came again in 22 when rates spiked up quite a bit and bond prices fell. WAMCO kind of having that longer duration posture, also kind of risk on, really took a hit, and so they saw a lot of client assets leave because of that. But then even with just, and this is, they report asset values quarterly, so we don't know an official number, but they were around 67 billion as of June 30th. Morningstar, because they can kind of see flows, is expecting they've already been pulled out about $5+ billion in the last quarter or so. And so again, from our standpoint, performance-wise, we're okay with what WAMCO has done, how they fit in our portfolio. It's been all right, but that said, qualitatively speaking, certainly a lot of red flags, a lot of concerns with other clients and significant assets leaving. We think it's more prudent for us to look for a replacement and move fixed income or about $100 million with them to another strategy. Any questions on that? So what we have here, and you can flip to page 7. But just like with all of our asset classes, our research team, they're focused every day specifically on the various managers in the universe. And so we do have 2 in particular in our bench that we think would be a great fit to pair with IRNM and portfolio. Both of them being in that core plus space, as I was explaining. So it would be a great complement with IRNM. The firms are Janus Henderson, and then Amundi Pioneer is the other. Both firms very, very large. You can see just that on that, as the third row down. Over 360 billion at the firm for Janus, over 100 billion with Amundi. Strategies, both are very large, $5 and over $8 billion. So ultimately, we were comfortable with the stability and the team. Both strategies have been around for many years. Maybe the last thing, that last line you can see from a fee perspective, you can see actually would be a discount in terms of both of them than what we're paying with WAMCO. With WAMCO, we're paying 42 basis points all in, and you can see with either Janus or Amundi, we'd be right around that high 20s or 30 basis points from a fee perspective.
Let's stop a moment, do a sanity check. We're concerned about the attrition and assets at WAMCO. And these other 2 guys are a fraction of WAMCO's assets under management. So why are we not concerned about their size if we're concerned about WAMCO's size?
So it's more so the direction of WAMCO's size. So again, I mean, from a size standpoint, what you want is to be able to managers to be large enough that to have purchasing power, certainly, and be able to drive down trading costs, have access to various securities, and also be able for them to be stable enough to pay for talent, to pay for resources, technology, and all three of these managers, including WAMCO, certainly within that realm. More so we worry about as we think about from an asset size in WAMCO, continue to have more pressure internally as they continue to have clients leave. As a reminder, WAMCO, they are much bigger in assets, but they're also significantly bigger organization. And so they have to spread those revenues out, which revenues ultimately managers are based off of dollars they have invested. Spread it off over bigger teams, larger resources. So ultimately, we'll put some pressure on where their budget can be allocated to, what they can spend, what type of talent they can attract. And ultimately with any organization, when you start to see a mass outflow of revenue assets, you tend to see typically people leave after that as well.
Do you recall what the asset strategy assets are with international, with IRR&R?
I don't remember exactly what that is. It's certainly,
I know when we first put them in this portfolio, I knew some of the people there personally. We put them in the portfolio a long time ago. But we liked the size of it because they had the ability to go after and have a meaningful position in smaller issues. And we thought that was an attractive strategy to add to WAMCO's focus on. WAMCO has to go at much larger issues. Issues meaning fixed income
opportunity sets. Yeah.
So I was just wondering if you recall what their asset base is.
I don't know. I don't recall what it is. They've certainly continued to get more popular. IRNM has is they've no longer kind of this undiscovered team strategy, but they still tend to be very thoughtful. I know about their size. It's really the size of their team that they support.
Okay, let's go on.
Can I ask?
I'm sorry.
Yeah.
It looks like they both have two vehicles, commingled fund and a mutual fund. Are you tending toward either one in particular?
The commingled fund is significantly cheaper for both. So I think that would make more sense.
I did notice the mutual fund under D has like 60 basis points as a overall, which is kind of surprising given the fact that their commingled fund is very much lower or comparable. And then I guess the other question I have is the benchmark is actually different on the last one. I can see the benchmark for Janus is the same as Western, right? Is there a difference in the holdings as to why they have a different benchmark?
So the different benchmarks, so the Bloomberg US Aggregate is the most popular, broad benchmark among fixed income managers. So it's actually the one we use for both WAMCO and IRNM in our performance reports. It is more of a core benchmark. The universal includes more of these plus sectors and some of these we're kind of higher risk. So it just tends to be a preference of the investor, which one they tend to choose. Ultimately, and I have the information for both. You can kind of see their returns on the following pages, that there are some differences, but they're in terms of returns, but they're not that dramatic, and it really just becomes a preference. But both of these managers would and do run the same portfolio regardless of which.
So this is their
This is what they,
suggested benchmark, not which you, okay.
correct.
And the revenue. One of the things we have to try to gauge is the value added. One can just buy the Bloomberg aggregate, just buy the index.
Right,
You only go back to managers if you can beat the index.
correct.
So why wouldn't we gauge an active manager against Bloomberg aggregate, period, as opposed to the universal?
So that's typically our
To measure the value added that they're bringing
right.
to us by not, our default position would just be to buy the index.
Correct. And especially from, on the fixed income side of our portfolio, again, we are looking for active management there. We are looking for value add, but in a different way than on the equity side. Ultimately, with our fixed income managers, we want them to add some value, but really be there to be that volatility protector and protect the portfolio. So typically, we say, we could The investable option typically is the Bloomberg aggregate that we can go out and compare to, kind of the broadest measure. So that's what we use.
Well, I'm thinking regardless of what this firm suggests that we use, I'm just, and board may disagree with me, just seems to me that the Bloomberg aggregate would be a better benchmark than the Bloomberg universal, because it would allow us to measure the value added that they bring versus our simply doing the aggregate. It may not reflect what they do, but what they do is the value added that they bring. Right?
Yeah, no, and especially on the,
And for example, a very simplistic example, let's say you're investing in large cap core equities. But one large cap manager would pretty almost replicate the relative weighting of the S&P 500. And the other large cap core manager has a 10% position, a 15% position in NVIDIA. We would still measure them against the S&P 500 because that's value added that they bring. Is my logic
yeah,
fair?
no, and I think
My
especially,
logic isn't fair, just tell me.
no, you are. I mean, that's when we go back to, capital market assumptions, we are using kind of the broad
Yep.
asset classes, indices where we want exposure to, and to your point, Mel, and then we have managers to add value onto that. And so exactly, if they're going to add value, they are going to be different than the benchmark. And so sometimes there is this not perfect matchup of the benchmark with what necessarily they do, but it's exactly to that. It evaluates the value add that they are above what we're modeling.
Which is why we're using an active manager rather than the default position.
Yes.
So well, you have to make your recommendation as to which one we're going to use. But if we were going to use that other one, Amundi, which I'm not familiar with at all, I would suggest that we can print their universal benchmark and make our decisions on the basis of the aggregate.
I agree.
Does that sound logical? Now, it may be moot depending on which one you recommend.
Yeah. So perfect. Maybe just in the interest of time, let's hop to page 9. And so, and you can see here, so Vicky, your question, what we have here is performance and different data on the bottom. And I definitely want to get to the bottom. I think it's the most insightful. But so you can see it's different return data for both kind of the broad US aggregate, and then the universal below it over the 1, 3, 5, and 10. You can see those differences. You can see IRNM, Western's returns. If it's in red, that means it's underperformed the aggregate, which we compare ourselves to at that time. And then you can see for the two managers, Janus and Amundi, their returns over the same time period. And so certainly what you want to point out, probably not surprisingly, we would bring managers who would have positive returns, at least relative to the benchmark, is on our list. So you can see some strong returns from both Janus and Amundi over time. Janus, very similar, not over the 10 years, not that different from what you have in IRNM. Amundi, again, think back to that risk spectrum a little bit, and I'll show this visually, does tend to be a little bit more in that plus area than Janus does, which we think could be a good complement to what we have with IRNM. And so what you can see there, after the returns, we throw the standard deviation, the 3, 5, and 10, which again, standard deviation is measure volatility, which is certainly a big component to risk. How high your highs, how low your lows. The higher the number, the more volatile you are. And what you can see is certainly, so Western, certainly more volatile than IRNM. Both Janus and Amundi, which we like, bring that volatility down a little bit. They're more volatile than IRNM, but less volatile than Western, that we think, again, would be a good complement and opportunity to use. Now, I think a great highlight of...
Why would Western be more volatile than either of these guys? Alternative. And conversely, why would these guys have less volatility than Western?
So Western in particular, certainly if you remember when they've been in here, they not only like to make bets they like to more actively trade the portfolio. So more bets, not only from an individual security standpoint, where they tend to leave further out in the more speculative corporates in particular, higher yielding, which certainly we know can be volatile, very sensitive to the economy, but also as it relates to duration. Western, part of their issue coming in 2022 was not only that they were certainly in some of these higher yielding securities, but they also had a longer duration play on than most in the field. So both of those, whereas most managers tend to shorten up their duration, at least relative to the benchmark, cause them to be a little more volatile. So Western certainly takes the approach and has that profile in the fixed income space. They go for really high returns over long periods of time, but that will, they'll certainly take some losses over as well. And you see that here at the bottom. So for the bottom, how you look at this, we have, our two managers, IRNM, Western, and then below it, Janus and Amundi. And we structure this in sections. So the 3-year, 5-year, and 10-year. And when you're looking at the 3-year, first off, the batting average. This is just a measure of consistency. We all follow baseball, at least a little bit in this town. And it's the percent of months that you outperform the ag, that you, over a 3-year, and then over the 5-year, over the 10-year. So what percent of the months? It doesn't know if you're a big outperform, a little outperform, but how much percent of the times you outperform. Up capture measures, if the Barclays Ag is up 100, what are you up? So what percent of that up capture are you up? If you're over 100, that means you outperform to the upside. If you're under 100, you underperform to the upside. Down market capture, same theory. If you aggregate the periods where the Barclays Ag is negative, if the Barclays aggregate is down 100, what were you down? If you're down less than 100, you protected. If you're down more than 100, you underperformed in a down market. And so you can see IRNM, our core manager, fairly consistent, outperforms typically more than half the time. They tend not to, at least over the 3 years, they're close to the up capture, but protect on the downside. And over the 5 and 10, they get a little bit more in the benchmark on the up, but protect on the down. Western, a lot more on the up, a lot more on the down. That's their profile. Janus and Amundi in between that. You can see certainly in particular some really impressive consistency from the Amundi portfolio and from Janus, but from Amundi over time. And you can see actually over different periods of time, Janus has been able to outperform on the up and basically be in line with the down. And what you've seen actually from Amundi is some strong performance to the upside, but relatively being able to hold that protection on the downside. As certainly a lot of security analysis and the individual selection with the corporates that they hold. So certainly pretty impressive from a return standpoint. I'll just 2 more pages, flip to page 11. And I think this is a good graphic of the left-hand side is the 5-year, the right-hand side is the 10-year. And you can see kind of the managers or the different colors, what the letters are going down. A and B are our 2 managers, C and D are the 2 potential, and then E and F are our benchmarks. And again, what we're measuring, this is what happened over the 5-year and the 10-year, is risk going up and down. So the higher you are, the better return you had. And then to the going east and west is volatility. The further to the right, the more volatile you are. So you can see IRNM definitely huddles around the benchmarks for us, right? That's there for our consistency, our stability. Western over time, you can see the 5-year certainly lower. They've tried to add return, but they've certainly added quite a bit of volatility. And you can see certainly what we like, C and D, Janus and Amundi, you kind of being in between that. They are going to be more volatile than IRNM, but we think they expect them to add some return over time. And you can again see kind of the big difference really between even Janus and Amundi. Both of them are less volatile than Western, but Amundi's closer, but has had higher return over time. Now, what this chart I think is great, if we look at this, but then flip to page 16, and it's the same thing, except we're comparing not just the managers, but the combinations of the managers. So page 16. So A is our current portfolio. That's half IRNM, half Western. B and C are half IRNM, and then B is half Janus, C is Amundi, and then D is the benchmark. So you can see how they would look. So you get a sense, certainly that shrinks that in a little bit. Ultimately, our recommendation would be to go with Amundi. We do think ultimately they'd add some higher return over time. They've shown a good ability to do that. We think they'd be a good pair with the stability that we have with IRNM. if the group feels more comfortable with Janice, obviously we're only showing two. We really like both of them. But push comes to shove, I think we can afford a little bit more volatility on the fixed income side for a little bit more higher return with the Monday over Janice. And that would be our recommendation.
Let me ask this question, the same question asked when we're evaluating Silchester. Why would we not incorporate both of these managers in the portfolio? So we have three managers in total. Why not do that? These are the best two you would recommend to us. Why not back both of them? Is it a fee issue or is it?
It's not a fee issue because all of them, well, so we go back to the fee. I mean, from what we're currently paying now, it would, I mean, it would be like basis points. It'd be maybe a basis point impact. Wouldn't really do it. Ultimately, it's from a performance standpoint, we could, right? I mean, there's no major issue on the fixed income side. It ultimately, at the end of the day, it's just another manager for us to monitor. It's another manager we have to set up with our custodian. And ultimately,
When you say we have to monitor, you're talking about we ACG or we?
both. I mean, we're fiduciary. Everyone in here is a fiduciary.
You're following these guys anyway.
Well, yeah, no, it's just more, so you're right. It's actually more so the board, another manager, the board has to be fiduciary too. Somewhat a cost for the custodian. From a performance standpoint, it will, sometimes you can be overly diversified. And, the great returns that, just as they might wash each other out to the downside in bad times, they'll wash some of the good returns out that one had versus the other.
If I had a crystal ball, it would tell you how much to put in the video for the next 10 years. I really don't know. They may add. They may be exactly the same, or but somehow they may detract.
Right, so ultimately,
But based on the numbers here, if we were de novo, I would say, what's wrong with just adding both of them? Or having having all three of them. I really liked IR&M. I have for years and years and years.
Yeah.
I said I knew the people there. I wanted to add the other two. Let the dice go. We can always delete one. If something goes wrong. Unless it's a fee issue, unless it drives up the fee structure in a sector that doesn't generate high rates of return typically anyway.
no, I mean, there will be a higher fee. It'll be very de minimis. I mean, I think a Monday's fee would go, from 29 basis points to 28 basis points. Or from 28 basis points to 29, there'd be a de minimis custodian fee. I mean, ultimately, it's a preference thing. If you really want to do it, I'm not going to jump in front of you, stop you. I don't think it's necessary. And I think if you look at this, my recommendation being a Monday, expectation would be that if you brought the two together, you'd lower return a little bit. You'd lower volatility a little bit, but you lower expected return a little bit.
Maybe.
But again, it's all within, you show me a crystal
Historically, I
ball.
would say we would have lowered the return a little bit
Yeah.
historically. I don't know if no one knows whether that will be in the future. Jody, you're a fixed income person. What do you think? And I like a Monday. I don't have anything against it. I don't have anything against Janice Henderson.
Yeah, I think they both look like good candidates to replace Boston. Yeah. Yeah, I see the fees are a little higher for a Monday, which you're recommending. I'm on the fence why we would do two versus one. At what point do you having too many managers? Having three, is that good?
How much money do we have from us here?
It's about 100 million.
Total fixed income,
No, 200.
220,
Yes, and,
almost 220 million. We're almost at
I think the fees are going, like
200.
you're saying, I think we're gonna be close because they're of the breaks.
Because I don't work with managers.
It's gonna be about the exact same,
Mhm.
about 28, 29 on either of them.
Mhm.
It's not gonna make that much difference in terms of the fee, but be about the same.
So Vicky, what are you suggesting?
I don't
Although you're not
vote.
voting.
I don't vote. I'm the conservative point. I always go, and I know history doesn't portray the future type thing. But in terms of managing and that, I would actually be going more to Amundi just because of the fact that I looked in the whole thing, the discussion that you were having earlier was the fact that okay, 1 year changed it. You know, so I'm looking at, I'm going, okay, did they just have a really good last year? Because when you look at these returns, that could influence all of those year benchmarks, right? But then when you come down to the next schedule in terms of, okay, the up and the down, it looks like they're consistent in terms of, it's not just 1 year that did it. So the numbers look, in terms of the batting averages, the up caps,
Mhm.
that one's very
Paul,
interesting.
Paul, what do you-
Why wouldn't we just go with Janice then, pardon me, on Monday and drop IRM as well?
Yeah, I would rather stay with,
They've done a superb job.
And then there is a little bit, Paul, just with the size of this. So that would be 20% of our, over 20% of our portfolio with one manager. And that's, rule of thumb, we like to be like 10% of our portfolio with one manager is kind of the top. I mean, it can kind of, if we like to manage it a little bit more, we can go higher than that. It's not a hard rule, but that's really the biggest thing. And then with, again, this is the real safe area of our portfolio. And so we like IR&M's real defensiveness, on that.
You know, one of the things that's not really been talked about, and I don't know how that influences this, is IRM is actually investing assets for us. So that's an individual.
They're doing what I'm saying.
They're investing assets for us. I mean, they are in the trust account and they are investing for us versus these commingled funds. I mean, because you do have separate. So we only have 3 individually held managers. That's Granite, Jameson, and IRM. So that's a little different strategy too. They are actually investing directly for us with assets that we are holding in our account. So I'm not exactly how that actually portrays in terms of whether there's risk or that. I mean, maybe you could talk more to that, but that is a different strategy from the fact that you've got something split between an individually held asset fund with a manager and then versus a commingled fund. That could be additional discussion.
Yeah, so the difference is, so with a separately managed account, so we work at our custodian, if you go look in the IR&M account, all the bonds are held there, and IR&M gets trading authority to move within there. So technically, the county owns all of those bonds,
That's pretty good.
and IR&M
Yeah,
has the authority to
that's
trade.
kind of cool, yeah.
In commingled fund, like what these are, for instance, Amundi has one big account that they trade all their bonds in.
It's like a mutual fund.
Yeah, and an investor owns a percentage of that fund.
Yeah.
That's how it is.
Right.
From a performance standpoint, if we wanted to, the benefit of a separate account, if there were things we wanted to do, we could to direct one of these managers to do, like never buy an Apple bond. You can do that in a separate account. You can't do that in a big, but frankly, as it relates to fixed income, there's not a thing we want to do that.
Okay. Jerry, what are your thoughts?
Monday's fine.
Would you do both?
No,
Just a Monday and pair it with IR?
Yep.
Or, is there a reason you would not do both?
yeah, you know, why would we water it down?
All right. So we're gonna call for a vote. There are 2 alternatives. One is just adding a Monday, the other is adding a Monday and Janice. So let's have a vote first on the motion on a Monday alone. We only have, we have 4 board members here to vote. So may I make a motion that we add a Monday alone, which doesn't mean that's my preference. I'm simply making the motion to get it on the table.
What is your preference, both?
That would be my preference. It's 22% allocation. 7% each sounds about right to me, but nevertheless. I'm
So would you take out money out of IRM? So you were talking about 22% total and then allocate each a
You
third.
have to.
So you're actually talking about reallocating to IRM as well.
You had 3.
You're looking to go a third, a third, a third.
I would think so, unless we can do just split what Western Asset has between the 2 of them.
It just-
We can do that as well and just leave IRM alone.
And so my recommendation on that is to not, and again, the full caveat, this is all well within, show me a crystal ball and I'll tell you what happens. Like, it's not, they're very close. And if you were to do a third, it's certainly not, you're not a huge risk. What I would say is for our portfolio, we are a long-term investor. We want to get higher returns, but I think of IRM as really the most stable piece of our
Mhm.
portfolio. And so having that at 10% of our portfolio, I feel more comfortable with. And then, so that's my recommendation, my thought.
Fine. So why would you, let's get away from the motion thing. So if we were to do all three, it would be IRM at 10, 10.5, and a Monday at 5, and the other at 5.
And really then it's watering down a little bit and that they,
Basically,
Over the-
because you don't know who's gonna win.
you don't know who's going to win. You're just going to mix of both. And at the end of the day, you're going to get probably a very similar, maybe a very similar, very close return over long periods of time. I think probably a little bit less return. But then it's more fiduciary coverage for the board.
Let me go back to the motion. I can make the motion again. I need a second and then we can vote. All those in favor of a Monday alone? Ma'am, yeah, I'd like to make a motion that we engage a Monday alone to replace Western Asset. That's a motion. I need a second.
Second.
Okay, may I have a vote, please? What,
All those in favor
wait a minute, no, yeah.
of your motion?
Excuse me, I'm talking process now. How many people do we have to have for,
Three.
just three?
Three.
Three of the four of us?
Right.
Okay, fine. All right, may I have a vote?
In order for the motion to,
Oh, in order for them up, yeah.
Okay, all those in favor of a Monday alone?
Aye.
Jerry?
Yep.
Paul?
No.
Okay, that seems to fail, because even if I voted for it, it'd be only two.
Well, Paul and Jody both knows.
Those, yes.
Thank you.
Okay, the
Paul
other
and
one,
Jody.
right, and Milt, you were a no.
yes, yes.
Okay.
Yes. The other motion, the only one that we're left is to, number one, we leave RM alone. Number two, we hire both Monday and Janice Henderson to replace Western.
Second.
All those in favor?
Aye.
So it's free. And we'll see. We may beat it down as time goes on.
When was the last time we
And that motion is not
switched up the
to
allocations?
allocate out of our other existing
I said we
manager.
leave RM.
Just 5 and 5 and 5.
Five and
Okay.
five.
How often do you make changes like this? When's the last time you?
It's more free. It's,
Oh, so Chester.
it's,
It's, probably not even once a year, but that's once every other year, maybe.
Silchester this year.
Silchester.
Yeah.
Yeah, no.
I mean, there's been at least once a year.
And I guess to this day, as much as I like Silchester, one of my favorite managers of all time, I used to recommend him to my clients when I was at Mercer. When they had a $25 million minimum, when they had a $50 million minimum. I really liked them. They've changed a bit over time, but I really liked them. But I regret to this day that we didn't have both Silchester and the other manager we were looking at, which I was not even aware of. Thought was it Causeway or something like that?
Probably.
Wasn't even aware of the manager before you brought it to my attention, which was great work on your part. I wish we'd done both. We'd be better off actually today. Both that side. Okay, is that resolved?
Yes.
Okay, well, next on your agenda, anything else?
There was a request for just follow up on our real estate allocation breakdown. Shariq had made that request. It's typically in our.
That's a matter of information. Is there anything dramatic in there that we need to be aware of?
No.
Now, each of the managers has a relatively small well, not small, has a minority allocation to office, correct? As I recall Jason saying before.
Yes, so, and maybe just the real estate thing, page 5, is ultimately we have less office than the benchmark does, both in total, all three of our managers, and actually all three of our managers individually.
And yet all three managers, and office is the part of the market that's most affected, been most affected after this.
Well, certainly post-COVID, yes, has really taken a hit.
And all three of the managers put up a gate. In spite of the fact that they have a
Right.
minority investment in office.
Correct.
So that didn't help us much, it guaranteed liquidity, did it?
No, pretty much all managers in the industry put their gate up.
Okay, I'm sorry. What other observations would you like to make on that?
We're well diversified within the portfolio. I mean, really, I think there's, like I said, I think there was just a request that, do our managers diversify? And, we see it from a performance standpoint. All three of our managers have done well versus the Odyssey. All are well diversified relative to the Odyssey's particular office question. We have less office than the broad benchmark. And we make that up in multifamily, and also really the benefit some of our managers do is investing in some areas that aren't necessarily high in the benchmark, like self-storage continues to become more popular area that we're getting exposure to, data centers, et cetera. So,
Yeah.
Well-diversified portfolio.
The board that I said, public held company, that I mentioned that Brian Hanson and I both sit on the board of, it's a publicly traded REIT. Heavy office, and it sucks. I mean, it just sucks to be there. I wish you could be any place else on the planet than in that sector. It is really, number one, you didn't get much return. Number two, you couldn't sell off properties very rapidly because people couldn't get financing. Now that they get financing, you still don't have employees who want to go back to the office. They go back to the office. So they're hit by two things. And it really sucks.
Mhm.
Okay,
That's,
well, fine, we're in all three of them anyway, as we said. We just will have a double check before we reinvest in any of the three. As we get distributions, we may choose not to reinvest.
yeah.
Draw down, pay benefits, et cetera. And at some point, we'll revisit what the appropriate allocation should be. Right now, it's sort of a moot point as to what the appropriate allocation should be because not getting enough money to make it happen anyway. Okay, is there anything else you'd like to chat about?
That's all we have for today.
Okay, you're going to, you and Jason will be here for the asset allocation strategy meeting
Yes.
as well. That's important. It's important to me personally.
Yeah.
I feel really sensitive about the fact that we were 80% funded ratio on a market value basis. And then we dropped down into the 60s. I hated that because my personal objective is that we get it up to 90. And then we can do a lot for retirees if you have a predictable 90, 89, 90, 91% funded ratio. You can do a lot for retirees at that point, but you can't do anything for them if they're down in the 60s, 70s. So
It'll be a good discussion.
yeah, it's very important. And I'm not talking about over a 20-year period. I'm not going to be here in 20 years. County will be, but I won't be. I'd like to see us make some real progress again, because we're making great progress. I'd like to see us make some more progress again in what I call the shorter term, which in this business is really over the next 5 years. Let's just make certain that we really believe we're properly allocated over the next 5 years, because you can always change it as you go on a rolling basis.
Mhm.
Okay, that's what I'm coming. That's just me.
Yeah.
I only have one vote. Okay, we're gonna have to have a motion to go into
Wait,
closed
you
session.
just want to go through other business and just for comments on the agenda? Just call those items.
Any other business? Yeah. Becky, anything else from your point of view?
No, sir.
Any other business? We're gonna have enough on our plate at the next November meeting. And Jerry, in a way, in a strong way, I really hope you're still here because you've had the benefit of a number of years of experience on the board and inside. On the other side, I hope your successor can at least be here and audit the meeting, if not vote at the meeting. Because this is a great learning opportunity for your successor.
Mhm.
So I'm torn, but I hope you'll be around. Okie dokie. Visitor comments? I don't think we have any visitors in here.
There's three, but no one's
And Mary.
Marion's still on?
Yeah, Mary.
I thought Marion was leaving.
see what's later towards the end.
All right, the meeting is open for visitor comments. Marion, do you have any? Is she muted? I'd be on her side.
Jeff, do you have?
I don't have any comments today, but thank you.
Good morning, Marion.
Good morning. Although Milton, could you clarify one thing? At the beginning of the meeting, when you talked about the ordinances and the request to have COLAs discussed annually, did you say that that was approved by the board to change the ordinance or not approved?
The ordinance has not been changed. It has been adopted by the board to put language into the ordinance that the board would formally review the advisability of recommending a COLA each year upon receipt of the actuarial report. That will be in our recommendation to the county when we finalize the ordinance, which we're going to try to do, make some progress on this morning. Finalize the new proposed ordinance. Does that answer your question?
Okay, thank you.
Okay. Doesn't say we will be able to do it, but that we'll be able to grant a COLA. It says we've committed that there will be a review as to whether or not to recommend a COLA.
I understand that.
Okay. Any other comments? Alrighty, I'd like to.
Before we take a vote on closed session, I'd like to request a 2-minute recess.
All right, fine. The board stands temporarily adjourned for a couple of minutes. And then we'll go into closed session. And we'll talk about a personnel item. I beg your pardon?
I would just vote whether or not you want to go into closed session.
Yeah, we have to vote to go into closed session.
Yes.
With a roll call.
If they-
I'll see you guys.
See you.
Because he has all the knowledge.
Everybody's off, but we're gonna go into closed session on that, so.
Yeah.
No,
Well, I think we're adjourned and we're still in.
Yeah.
the thing.
excuse me. I just want to make certain that there's nobody on.
No, we're not in closed session yet.
Not very good.
No, that we haven't.
Wait, okay,
Oh, and we go into
Well,
closed session.
Mill, I do want to interject. You have to take in open session, a vote to go into closed session.
I realize that, but I want to understand who, if anybody, is still listening in.
There's
Can I
one,
make that clear?
there is.
Me, Mel.
Paul,
Paul and
Paul,
Cyril. Paul and Cyril.
Let's fail with intelligence,
Okay,
but it
fine.
won't be done.
All right, good. We have a motion to go into closed session.
second,
All in favor?
I.
No, we have to do the roll call.
Roll call.
Roll call vote. Roll call vote.
Paul Ham.
Aye.
Lieutenant Colonel Gerald Lord.
Sure.
Jody Patterson.
Yes.
Anthony Waskowitz. Milton Wilkins.
Yes. All right.
I'm sorry, Paul, you did.
Yeah. All right. There are two matters. One is a personnel.
Wait,
I'm so sorry. If you could just give Jeff 1 second to officially posting closed session online.
All right, we will read this. I move that Anthony Weaver's application for retirement benefits be denied because Mr. Weaver is disqualified and ineligible to receive any retirement benefits pursuant to section 204.430 of the retirement plan. Mr. Weaver's convictions on 4 counts of felony wire fraud in January of 2023, as set forth in Mr. Weaver's guilty plea agreement. Other records of that case and in violation of his duties as a public employee and servant of St. Louis County show that Mr. Weaver was convicted of felony offenses in direct connection with or directly related to his duties as an employee of St. Louis County. And the convictions, facts, and circumstances of these federal law offenses are substantially similar to one or more of the enumerated offenses under 204.430. In addition, I move that any funds received by Mr. Weaver related to his application for retirement benefits be returned to the retirement plan.
Second.
All those in favor?
Aye.
Aye.
Sorry.
All right. Okay, in accordance with the section 204.360, the plan, I, that is the chair, will sign a letter to notify Mr. Weaver of the board's decision to deny his application for retirement benefits. And I, the chair, will advise him to return any funds received by him to the county for deposit in the, or redeposit in the retirement fund. Okay. Anything else in that matter? Then I think we are open for a motion to adjourn.
So move.
Second?
Okay, all in favor of
Aye.
adjourning? That's unanimous. That's good. All right.